Welcome to the Zone of Genius, the podcast where money talk meets real talk. I'm Dana Wilson, founder and CEO of CHIP, which stands for Changing How Individuals Prosper, the financial services marketplace connecting you to trusted financial professionals who get it. You'll hear from experts from our platform who break things down in a way that's honest, actionable, and easy to understand. Whether you're building wealth, healing financial trauma, or just figuring out your next move, this is your go-to spot for real conversations that move you forward. This is your zone to learn, grow, and take charge of your financial story, one empowering conversation at a time. If this episode hits home, subscribe, share it with your people, and of course, leave us a review. And when you're ready to build your financial team, head to chipprofessionals.com to find the right pro for you. We'll see you there. All right. Hello, everyone, and happy Friday. At least it's Friday as we're recording this episode. So if it's not Friday when it airs, well, happy Monday, Tuesday, Wednesday, Thursday, and Friday again. But for all of those who are just hopping into this podcast, thanks for listening. There's been a lot of great episodes and conversations going on. So we appreciate you supporting and subscribing, and also making sure you're not just, holding this information for yourself, but you're also sharing it with your friends and your family, especially within these economic times where people just need good, solid information from credible financial professionals. And really excited to bring on our next guest. This episode is titled Tax Traps and Triumphs, How First-Gen High Earners Can Win in Today's Economy. And I'm going to bring on Luis Rosa. Luis.
Thank you so much,
There we go.
Dana.
There I am. Removed myself. So welcome, Luis. Excited to have you on here.
Thank you, Dana. Excited to be here.
Yeah. And for all of those who don't know how amazing you are, I know a lot of people in our financial industry know, but please tell people a little bit about you and what you do.
Oh, thank you. I'm a financial planner. I own my own firm called Build a Better Financial Future. And I also have a podcast by the same name, Build a Better Financial Future. And I came to the US from Dominican Republic as a kid, and I knew nothing about money. It was more about survival at that point, right? And my parents, being immigrants, were not in a position to teach us about the US financial system either, because they usually worked like factory jobs and never had any type of benefits offered to them, like a 401k and insurance policies and things like that. So we had to learn two languages. It was English and money. And as I grew older and learned about financial planning and eventually ended up being in the industry, I realized that there were a lot of people like myself who eventually were the first ones in their families making good money, right? Six figures, but still felt some inadequacy around money and didn't know what to do. Some of them still living paycheck to paycheck. Their problems just got bigger, right? They drive the nicer cars and the bigger homes, but still there was no actual wealth being built. So I decided to launch my own firm and help others like myself, just with strategies, especially taxes in this environment, ever-changing environment, right? Just how to optimize your finances.
Absolutely. The one thing, to quote Biggie on a Friday, more money, more problems, right? When you said it, I was like, there it is again, right? I mean, it is extremely, extremely true. So to dive in, as you just kind of mentioned, given the recent economic shifts, including, increased IRS scrutiny, changes in a lot of the tax laws, which almost seem like it's every second of the day at this point. What's the most cost-effective or most costly tax mistake first-generation high earners are currently making?
I would say it's not being proactive. Taxes should not be a mystery to people. And I know they can be complicated, but they don't need to be a mystery. So what I mean by that is most people usually talk about taxes sometime during tax season, right? Between January and April. They show up to their CPA's office, or even if it's a virtual appointment, they just upload a bunch of documents. And then that tax preparer looks backwards. Kind of like if you think about it as driving, right? Looking in the rearview mirror and say, here's what happened during last year. Here's your tax bill, or here's your refund, right? But there was no planning involved. So if you think about it again, with the driving analogy, instead of looking in the rearview mirror, I think the biggest mistake people do is not look forward towards where they're going. You could, in fact, plan for your taxes. There are things that you can do throughout the year to minimize your taxable bill legally. And I think most high earners make the mistake of just showing up at tax season with a stack of papers, not realizing that there were things that they could have done during the year to probably make better decisions to have a better tax outcome.
I think that's true, right? Being proactive, being intentional is always the key. And just based off what you said there, are there maybe 2 to 3 things that individuals could just do in this particular moment that would help them with these mistakes?
Absolutely. I would say, one thing that people should be aware of is if they are a W-2 employee, to see if their employer offers a retirement plan. Most employers do, right? Like a 401k, for example. A lot of the times the employers match the contribution up to a certain amount. But when it comes to taxes, the amount that you can contribute to that retirement plan, most of the time you have two options. You can either contribute pre tax, which means that the money that you contribute up to a certain limit gets reduced from your overall taxable wages, or you can contribute post tax, which is the Roth option, which a lot of 401ks are now offering, where you don't get a tax deduction today, but you do get a tax benefit later because the money gets to grow tax free if you hold it for a certain amount of years. And then when you take it out in retirement. So these are the kinds of strategies that you should look into. Another thing that sometimes is often overlooked is people that have options to do a health savings account at work. If you have a high deductible insurance plan, a lot of times I speak with high earners who are still young and in good health, and they typically only go to the doctor once or twice a year just for like an annual checkup. So they don't really need, a plan where they need to be seeing the doctor every month, right? So in that case, sometimes if the employer offers a high deductible plan, it may actually make sense to have that plan because then you're eligible to open a health savings account. And then you can contribute even more money on a pre-tax basis, which also helps because that money gets to grow tax deferred. You can invest it within the account, and it's not a use it or loser plan. So you can continue to not use the funds every year, let it accumulate, let it grow, let it compound. And then on the back end, when you take it out, if it's for medical expenses, it's tax free. If you wait till age 65 and you don't use it for medical expenses, it's taxed just like an IRA would have. But if you use it right, it's a triple tax advantage. So these are the kinds of things that people can take advantage of in this environment.
Awesome, and thank you for breaking that down. I feel like the HSA is like the kid that everyone just kind of leaves in the corner and forgets about, but it's the most
Yeah,
powerful powerful tool that we probably don't talk enough about and break down. So we'll probably have to put a pin in that and just do a whole episode around that.
absolutely.
How are recent changes in interest rates and inflation impacting tax decisions for high earners? And what are some other things that they should avoid as it relates to interest rates and inflation?
Yeah, high interest rate environments could be an opportunity in some ways, right? So it's definitely not a good thing if you owe money, right? Because interest rates on credit cards and such go up. But if you are a saver, which I hope most high earners are, there's an opportunity to make more money, right? Like even something as a simple strategy as putting your emergency funds into a high yield savings account that pays a lot more than your traditional bank does. They are still FDIC insured up to the limits. You make more interest. Obviously, you have to plan for these things now because one of the things that may happen is that people then end up making more money as a result, where they weren't used to making that type of money in their interest. And that interest is a taxable income that gets added at the end of the year to your overall income. So you have to plan for that because sometimes the withholdings that you have in your paycheck may or may not be enough to cover all of your taxes at the end of the year if you have other incomes for example, interest from a high yield savings account or dividends or capital gains from the sale of stocks. So in these high interest rate environments, I think another thing to avoid is to make sure that you don't carry debt. I've seen credit card rates as high as 30%, which is insane. I don't even know how that's legal.
Oh my God, I feel
So
like it's not, but here we are.
yeah. So obviously, I think if you use credit cards, you can use them smartly, but doesn't mean that you need to carry a balance in order to use them and get benefits from them, right? You can still get your points and your rewards, whatever it might be, and use them smartly, but still make sure you pay that balance off. Because if you're paying 22% on a credit card, you're likely not going to get that rate of return in the market, right? So you're better off just paying off the credit card, right? So those are sometimes things that could be overlooked, and in these high inflationary environments, it's a lot to pay, right? It compounds against you, so you want to make sure that debt elimination is first, and then you take advantage of things like high yield savings account where you can make more interest than a regular bank.
Yeah, absolutely. It's like this is the time to be as disciplined and focused as you can, especially around your debt management. Um,
Yeah, and I think that building your emergency fund your OMG fund is should be even more of a priority, because there are a lot of things in these types of environments that are beyond your control. A lot of companies, especially in certain fields like tech, you see a lot of layoffs, right? Just thousands of people losing their jobs unexpectedly. And yeah, maybe you get some sort of package, with maybe a few months of severance, but ultimately you want to make sure that you have enough set aside. I think that's one of the most things that get overlooked, because it sounds very simple, but in reality, if you have 6 months worth of expenses in a savings account and you get laid off, I mean, you have half a year still to not lose your focus, right? You can still recoup and be like, okay, I'm gonna get back out there. Maybe it's an opportunity to switch careers or jobs, whatever it might be, but you have enough to cover your bills. Imagine if you don't. Most Americans right now, the Federal Reserve did a survey a few years ago, and it was over 50% of Americans didn't have enough to cover a $400 emergency without having to borrow, whether it's a credit card or from a relative from their 401ks. So if you have 3 to 6 months worth of expenses already, I mean, you're way ahead of millions of people already, right? And that gives you the opportunity to be able to go through a transition like a job loss or getting sick or divorce or death in the family. I mean, you never know. And now, because of this high inflationary periods, a lot of companies are doing layoffs. So you want to make sure you're prepared.
Yeah, absolutely. It almost made me think about even being your own transition insurance, right? You kind of create that for yourself, so you're
I
not
like that.
having to go out, right? I do like that. We'll have to coin that.
Yeah.
But yeah, you want to be able to be your own bank in a sense, so that you're not having to pull and do all these things. Because to your point, the first thing people tend to pull out of is their investments, right? And if you're not in a place where you're working and recouping that, and you drain that, what are you doing, and how fast can you recover if that ends up being your first go-to out of necessity?
Yeah,
So
you make a great point, Dana, because I've seen that happen, where people end up taking money out of their investments. Sometimes it's at the wrong time, right? Because maybe the economy is down or the market is down. So now you're selling prematurely. So there might be some tax implications there as well, especially if people touch like their 401ks. I've seen that happen all the time. Somebody gets laid off. Now they have access to their 401k, and instead of rolling it over to an IRA or waiting to put it into a new employer's 401k, they just tap into it. And then at the end of the year, they get the 1099-R with, hey, you made this much money. It's taxable income now all of a sudden. So it just compounds the problem.
oh yeah, and you don't want any of those bills, because as far as I'm concerned, that's a bill.
Yes, it is.
And it's a surprise bill. You don't want any surprise bills during that time. As we kind of move into like how to maximize wealth preservation for high income earners, especially around new tax legislation, what are some strategies that people should be putting in place?
Yeah. So one of the things that I tell people is that once you build enough emergency savings, and we have to move beyond that to investing. A lot of people are afraid of investing, first because they might not know enough about it, or they might have heard just terrible stories, from like the pandemic or the crisis in 2008, for example. But I tell people, in order to build wealth, you have to put your money where it can grow beyond the effects of two enemies that you have, which are inflation and taxation, right? So when you make money, the government wants their piece, right? So they're going to tax you one way or the other on whatever earnings you have, right? And number two is inflation. As you've seen in today's environment, it's the cost of living keeps going up. I grew up in New York City. I remember when taking a subway ride was just $1 for a token, and I'm dating myself because it was before Metro cards.
Listen,
But
I went through I keep saying this every time I drive through the toll between New York and New Jersey. I'm like, I remember when that was a quarter. And that's probably dating myself too. And all you were looking for was that quarter. And then I remember when it moved to 35 cents, and that felt like a lot. And now it's like almost close to $1. And I'm just like, what are we doing?
yeah,
Like,
that's crazy.
where are we
Yeah.
going with
So
this?
imagine, for example, that in 1990, let's say, I believe it was around $1 to take the subway. Imagine I would have put $1 in a shoebox or under my mattress, right? And then today I go and take that dollar back out. I only have $1, right? But now to ride the subway is way more than $1. I couldn't even get, one-way fare with that, right? That's because inflation creeps up on you slowly but surely. The price of things go up. You don't feel it every day. Now, when you have money in the bank, you're a little bit better off because if you have it in a savings account, you're getting some sort of interest, but that interest typically isn't enough to keep up with the cost of inflation. And on top of that, to add insult to injury, you have to pay taxes on whatever little interest you're making anyway, right? So you have inflation and taxation eating away at your money. So it comes to a point where I recommend that you have what I call three buckets, right? And the first one is your emergency savings and also any large ticket items that you plan on purchasing within the next 2 years. You have that money easily accessible in a high yield savings account, making a decent amount of interest. But the main goal of it is to have the money accessible because you're not planning on using this for the long term. This is something you're going to tap into relatively short, right? So you want principal safety, so you don't want your money to go down, and you want it easily accessible. So that's your high yield savings account. Then the midterm bucket is 2 to 10 years. Anything that you have as far as like ideas, could be purchasing real estate, it could be a business idea, planning for a sabbatical, things like that. You put that in your short-term bucket anywhere between 2 to 10 years, and that could be invested, right? And then 10 years plus is your retirement and legacy bucket. And that's usually the longest term where you can take the most risk with because you're not planning on tapping to that money for a while. So you could afford to take, let's say, if you invested in the market, some of the risks that go along with that, right? And go through the ups and downs and the typical roller coaster that the market does.
Absolutely, absolutely. I feel like there's just so many particular strategies, right? And people need to kind of just find their focus. How do you help people find their focus on which one sometimes makes the most sense for them?
Yeah, I think it's a matter of making things simple because you're right. There's so many options out there. There's just thousands of investment options, right? And some people sometimes may just, it's analysis paralysis because there's just information overload. And sometimes it's like, look, we can go the most passive way. Like, for example, investing in the S&P 500, right? These are the top 500 or so companies in the United States. You can just purchase the index. You don't have to worry about what you're going to buy, what you're going to sell, when it rebalances. You're investing in the largest 500 companies in the US. And that's very simple, right? The second thing I say, let's just automate it because then there's no thought or emotion behind it. Okay, every first and 15th when I get paid, I'm putting X amount of dollars into this fund. That's it, right? Just out of sight, out of mind. We have subscriptions, right, for Netflix and all kinds of stuff. We should do the same with our investments, because then there's no emotion, there's no thought process behind it. You're buying it at a certain day all the time, whether it's up or down, and you don't have to worry about making a decision about it. You just know that over time you'll see the results.
Absolutely, absolutely. I mean, we will put a subscription on anything and everything to ensure we get stuff on time or we have something to watch on demand. So it's like, why aren't we putting ourselves on demand financially, right? Why aren't we putting ourselves into that same subscription bucket? It's like we say
Yes.
it, we think we're going to do it, but then actually doing it in reality is two totally different things. I feel like we kind of hit on this a lot already, but is there anything else that you haven't mentioned based on this, economic volatility environment that we're in that people should be taking more advantage of within their HSAs, IRAs, or 401ks?
Yeah, just I always tell people if you have enough money, right, you want to optimize or maximize the contributions to anything that is tax advantage first, right? So that's a good point too, because there are people, especially high earners, where they have enough money where they have the ability to max out the 401k, for example. They can also contribute to an HSA and max that out as well. Then they might have the ability to contribute to a Roth IRA, depending on their income limits, right? So I always tell people, try to maximize whatever is most tax advantageous first. And then once you've already done that, then you put your money, let's say, like in a brokerage account, because the brokerage account will have some taxes in it, right? Even if you don't take the money out, as your money makes money, you may be issued some dividends or capital gains throughout the years and pay taxes on it, even though the money's staying in the account and you're not actually taking it out. So you want to make sure that anything that's either pre-tax or tax deferred or post-tax, depending on your strategy, you want to maximize those first and then continue on to like a brokerage account for the difference.
Absolutely. Cover the basics first, the needs and all the things first, and then
Yeah.
kind of jump into all of the, perks and extras and stuff. So I know, that we're in this environment where we're talking a lot about climate change and energy and all the things that people are really into from a social impact perspective, right? I would say green energy investments, electronic vehicles, solar, like all this stuff is really important. How can people utilize anything that's kind of green energy or make more green energy investments even within their, in their day-to-day lives that could reduce their tax liability?
Yeah, that's a great question. We had some really good credits up until recently. They still are, but I'm going to tell you some dates to be aware of. So there's a credit of up to $7,500 for the purchase of a new electric vehicle. And that was supposed to be there for several years to come. But with the new tax bill that just came out, it's actually going away on September 30th of 2025. So if you are considering the purchase of an electric vehicle, then you want to make sure that you do so before that so that you take advantage of getting that $7,500 credit. Same thing with solar. Right now, you can get up to 30% of the cost of solar panels, and that's going away at the end of the year. And there are some credits as well for like energy efficient appliances that you can use for your home, also going away on December 31st of this year. So there are ways that if you want to have like that, the social impact, that you can still benefit yourself financially because the government is subsidizing a portion of the cost. And with things like solar panel, in addition to benefiting financially, you also could potentially benefit later as well. Like if you decide to sell your home, it might be more appealing to someone to know that you already have solar panels installed or that they've been paid off and so on.
Awesome, which is extremely important, right? It's like we're all trying to find alternative ways, especially if you're in a moment where this can be beneficial. You've been looking at a vehicle, or you're even looking at maybe, other alternative type of vehicles to save energy or consume, or even just, being on the road in general, right? Like, how do I cut down on that? Is it a bicycle that I want to
Yeah.
start utilizing? Can I do that? Does it obviously also have other impacts and health benefits, and being able to maximize on those credits if there's home improvements and stuff that you're making. So I hope everyone is taking down those dates and really, putting themselves in a position to take advantage of that before the expiration. So I kind of want to move more into like the housing market, right? A lot of people, it seems like some people are also moving away from the purchase of a house and kind of looking at it from more of an investment property perspective, where more people are renting, but still looking at investment property and other opportunities. But for those who are also kind of considering both either buying a home, or even looking at things from an investment perspective, what are things that high income owners should be thinking about before investing in real estate, especially in this current economy?
Yeah, there's always that battle between what's better, buying versus renting, right? One thing I like to tell people is it's okay to rent. Like you can still make and create wealth for yourself without owning real estate. And the reason I say that is because when you buy a piece of property, there's the initial cost, right? There's a down payment, there's also closing costs. And then your mortgage payment is really your bottom number because it could go up from there. There will be at some point some unexpected expense in addition to your mortgage payment, right? Some repairs, the boiler breaks, HVAC system goes. If it's an investment property, you could have a tenant move out, right? It may take a month or two to get somebody else in there. You have to do repairs in between. So, it is very expensive to own and maintain real estate. Now, the reason why a lot of people make money in real estate is because, in addition to the fact that, for the most part, real estate appreciates over time, so it goes up in value. You're kind of forced to make that payment, right? If you're living in a home, or if you own a rental property, if you want to keep it, you got to keep making the mortgage payment, right? So it creates a forced mechanism for you to actually save, because every single payment you're making is bringing down the principal balance a little bit. And over time, the property is appreciating in value, right? So you are creating wealth. But in reality, when you compare that to, let's say, renting and then using what you would have spent on a mortgage and investing that. So for example, let's say your rent today is 2,500 and your new mortgage is 4,000. If you took what you would have put in a down payment and also that $1,500 difference and invested over time, you can also create a lot of wealth. The only difference is that you don't have to invest. There's no force mechanism. You have to have the discipline. which is why it's better to automate it if you can. But I always tell people, if part of your wealth strategy, or feeling like you've made it in some way, right? Because it's a very significant event to own a piece of property. If that's what's going to make you feel better, or you need it because you have a family and you want to be in a certain school district, whatever the case might be, that's fine too. But just realize that it's okay also not to own real estate. You can choose to rent. In fact, you can live in a similar house to the house you would have bought for a lot less than it would be to pay for that mortgage and the down payment. And you can just take that money and invest it and still do very well for yourself.
Oh yeah, not worry about things breaking down and happening. Yeah. I mean, I'm a proponent of both things as long as it makes sense too. I feel like sometimes we, jump into big projects, which could be, a project of buying a house, not realizing like all the things that come with it, right? To your point, it's not just the mortgage. It's like, did you prepare for something breaking? And do you have not only money for your regular emergency fund, but also the home emergency fund, because something is going to get drained, especially in this environment. It can drain fast, right? Something happens and now you got to pay $10,000-$20,000 to replace a roof, or something kind of crazy like that, right?
Yeah. When you rent, your top number is your rent, right? The HVAC system goes, you call the landlord or the management company,
right? You yell, that's their problem. Angry emails like, you were supposed to fix this on this date. That's about as much as you're doing. So
yeah, and you bring up a great point too, Dana. The emergency fund now you need two, because now you need a home emergency fund, because it's just a matter of time before something goes, right? And you don't want to then dip into your typical emergency fund, because now you're just gonna deplete that, right? So and even if the rental property, if it is a rental property, when a tenant moves out, typically there's that period, right, where you have maybe at least a month where you got to get back in there, paint the house again, do a little fixing before you get it ready for the next tenant. Well, now you're paying where you live and the mortgage for the rental property, right? So where's that coming from?
Yeah.
So yeah, it's something.
All great questions. I think I think you said the best question, right? Before you jump into something, it's like, where is that money coming from? Start there, and if there are no responses to that, or you're not sure, like maybe take another second or deep breath to really consider again, where is that money coming from, right? So of course, as most people know, I am a founder, entrepreneur, business owner, all of the things. I'm sure you work with a lot of business owners. You are one yourself as well. What, from an economic standpoint, tax standpoint, what are some advantages and also disadvantages that are going on for business owners, whether they're LLC, S Corp, C Corp, and what might be some things that they can take advantage of in this moment?
Yeah, I mean, one of the good things about the most recent bill that Congress passed was that they kept the qualified business income deduction, the QBI, which was supposed to expire December 31st, 2025. And basically, business owners are eligible to get up to 20% of whatever their net income was. So for example, if somebody is self-employed, let's say they just self-employed individual, they get $100,000 in net profit, they would get a $20,000 credit in their taxes that they can deduct from their income, which is great, right? So that was extended and made permanent. But aside from that, I always like to tell people who are self-employed to not forget about their future self, because sometimes we're so busy trying to just grind and grow that business that we forget about what we need to do for ourselves later. So as a W-2 employee, most likely your employer offers a 401k or something like that, right? You can create your own as a self-employed. Even if you don't have employees, there is such a thing called a solo 401k. So you can have your own 401k for your own company that you contribute to, even if you're just literally yourself. And that also allows for spouses to contribute as well if the spouse works for the business, which is a great opportunity because you can double the contributions. So technically you're both employer and employee, and you can contribute money as an employee, and then you can put a profit sharing portion as well. So something to be on the lookout. And another thing that sometimes people forget about too is also the taxes, because if you are self-employed, most likely all the revenue you're generating isn't being taxed at all as you receive it, because you're billing clients and you're getting money from companies, right? So you have to be very proactive and make sure that you either put yourself on payroll or you're sending tax estimates to both the IRS and the state if you live in a state with income tax. And, as far as entity structure, that's another good question. A lot of people when they first start, it might have started like a side hustle. So they may do it under their own name, or they might do an LLC, right? There's no particular tax benefit to being an LLC versus being an individual, right? The IRS looks at it the same. The only thing that you get is maybe some more liability protection under that LLC umbrella. But once you start making money where you feel like you can draw a salary from that business, then I always recommend to consider doing an S corporation, because what that allows is, I'll give you a quick example, like very oversimplified, but right now, if you are a W-2 employee, when you have your paycheck, you have federal, state income taxes, Social Security, and Medicare. If you are a W-2 employee, the employer is actually paying the other half, one half of Social Security and Medicare, and you're paying one half of Social Security and Medicare. If you're self-employed, you have to pay both halves of Social Security and Medicare. So if you are an S Corp, though, you can pay yourself a salary from the business as an employee, and whatever your profit is, you get a form called a K-1 at the end of the year, and you don't pay any FICA on that money, which is pretty significant tax savings. So it's a strategy that you can use if you're already making enough money to draw a salary from. I highly recommend you consider doing an S Corp, because then there's some tax savings there that you may be just leaving on the table, right? So.
Yeah, and goodness, because as a C Corp, you're just watching
Oh
all
my God.
the things go. It's
double taxation.
It's traumatizing.
Yeah, if you're a C Corp, you're paying taxes twice.
Yeah, so shout out to all of my people who are consistently traumatized every time they pay any kind of bills. Prayers and thoughts are with you. So before we hop off, given, again, like all the recent economic changes, but if we're only considering any tax-related actions before the end of the year, what is like one or two critical steps that first-generation high earners must do before year end?
Yeah, one thing I would say, if you are at a place where you're beginning to have some complexity in your life, I would highly recommend to work with a professional, whether that's a certified public accountant, right, CPA, an IRS enrolled agent. It's an EA, so that's an IRS designation for people who are very tax focused, or a financial planner who is tax focused, because there are, in fact, things that you can be doing today to minimize your taxes. And that could be things like making sure you're maximizing your contributions to your retirement accounts through your employer or your IRAs. Or your health savings account, or looking at your investment portfolio. If you have a brokerage account, there are ways that you can, if you have gains on one thing and you want to offset those gains because maybe you need the money to buy a property, right? Maybe you have some losers as well. That's called tax loss harvesting. So you can offset some of the gains with some of the losses you've had to minimize your tax liability, right? So I would say you want to take the guesswork out of taxes. You want to make sure that you're proactive, not reactive. You want to make sure you're planning ahead. So just having a simple conversation with somebody, you may not even need it. Sometimes if you're just a W-2 employee and it's not too complex yet, at the very least, you can go to the IRS website and they have an IRS withholding tool where you can plug in your numbers and tell them what you're earning, how much money you're having withheld, just to at the very least know that you're having enough taxes withheld, so that you don't have a surprise tax bill at the end of the year. Because a lot of high earners have, in addition to their salaries, maybe some stock options, right? Like some RSUs that vested, or they get a bonus, and that may bump them into the next bracket, and they may not realize. I get this all the time. I have clients that get a large bonus. Usually bonuses get withholding at 22%. That's the statutory withholding from the IRS. But they're in the 35% tax bracket, So I'm like, you didn't have enough withholding. I know it still felt terrible when you got that net amount, but it wasn't enough. So we got to plan ahead and, either increase your withholding from your paycheck or send an estimated payment so that you don't have this huge bill at the end of the year.
Oh yeah, again, like no surprise bills. As is like, it's always great to get those things, but then it's just like, well, how did I really plan for it from a tax perspective? And so it's not, oh, this is great, joyous occasion. And then at the end of the year, come tax time, it's just like, oh my God, this is the worst experience, right? It shouldn't feel like that, but it can, to your point, it very well can.
Yeah. And you had made plans with that money already.
Exactly. Like you already booked all the things and it's just like, nah, I'm already on my beach. You might want to come back. Like, you don't want any of those type of situations or conversations. Well, Luis, I extremely appreciate you coming on, dropping all these gems. I'm sure we're going to have you back to kind of dive deeper into even some things that we talked about today. But is there anything else that you want to leave people with before we hop off?
Yeah, well, first of all, thank you for having me. Yeah, it was a pleasure. Yeah, if you want to learn more about me, you can visit my website, buildabetterfinancialfuture.com. And there's links there for my social media and my podcast as well. And yeah, just don't be afraid to have the conversation, because, what's the worst that could happen? At least you're informed and you can make an informed decision and you know what to expect, right? So you'd rather do that than have a surprise. So just want to reiterate that, yeah, be proactive with your money, right? And I like everything that you said, like put yourself on your own subscription, be your own bank, right?
Exactly. Get your own be your own transitional insurance,
Yeah.
all of the things. And I want to double click into have the conversation, right? Talk to someone. AI is great, but AI may not know and see your overall situation, financial situation, tax situation, right? So you really want to make sure that you're sitting down and talking to someone and that can ensure that, hey, you're making the right decisions that are going to benefit you at the end of tax time, right? So have the conversation, use the tools and resources, reach out to Luis, who is a CFP and enrolled agent, and of course, continue to just be intentional and be disciplined. And we appreciate you listening to another episode of the Zone of Genius. You can find Luis and a lot of other amazing professionals on our platform at CHIP. So again, Luis, thank you for hopping on, and we'll see you all next episode.
Thank you.
Thanks for tuning in to the Zone of Genius, where we make money make sense. If you felt seen, heard, or inspired today, don't keep it to yourself. Share this episode, leave a review, and tag us in the moments that moved you. And when you're ready to stop doing it all alone and start building your financial team, visit chipprofessionals.com and we'll connect you with trusted experts who will help move you forward with strategy, support, and confidence. Until next time, stay in your genius.